Welcome. I'm Dana Dioria, Co-Chief Investment Officer and Group President of Solutions at Envestnet. Welcome to this Q2 2024 market recap. It's been another very nice quarter for the markets. Of course, only if you don't look too far under the surface. The S&P 500 returning plus 4%, bringing the year-to-date total to over 15%. Not a bad performance, particularly heading into the election season. Nice to have 15% in the bank. We could be looking at some volatility as we head into the second half of the year, but certainly nothing to shrug at where we are now. International markets a little bit more mixed. The MSCI EAFE index of developed economies negative by about 40 basis points. Emerging markets are actually outpacing the S&P for the quarter at about 5%. But the EAFE year to date is only about 5% and emerging about 7.5%. So, half and a third of what U.S. markets are delivering. Fixed income, a little less helpful. The Bloomberg U.S. Ag eked out a sub 10 basis point gain. Global Ag actually coming in negative by about 100 basis points. And this, of course, with some of the interest rate risk. U.S. corporate high yield, however, consistent with sort of this risk-on market, brought in about 1%. So year to date, the U.S. Ag is about 70 basis points down. Shorter term components are, contributing, but longer term components are losing. Still, for that standard 60-40 that so many folks are in, it's not been a bad start of the year. And of course, that's because of the equity markets. But that's only the case if you are in a market cap weighted or an actively managed investment that has, not material tracking error to market cap weight. And the reason for that is evident if you drill down into what happened in the sector returns this quarter. So pronounced dispersion. All of the sectors are positive for the year through June, but there's definite dispersion. So communications up more than 18% year to date. Consumer discretionary only delivering around 2.5% year to date. If we look at just at the quarter, technology was the big winner, gaining about 8.8%. Materials actually lost 4.5%. Why is communications and technology, such a big winner? Well, of course, it's that they have these Magnificent Seven constituents are a big part of that, right? Not the only part, but certainly contributing nicely. We know we've been in a top-heavy market for some time now, and that top heaviness has continued. That high concentration in the largest stocks in the economy has continued, and that's why you see what you see in terms of sector dispersion. So it works nicely if you're market cap weighted. If you're in an index or in an actively managed strategy that's a little bit more equal weight, where all of the index constituents are held at the same weights as opposed to what their price times shares outstanding weight would be, you're not experiencing the same level of positivity, and it's somewhat painful to be in. If you're in an index like that, you're tilted more towards lower priced value stocks, smaller cap stocks than that market cap weighted index. And while that methodology does tend to pay off over the long haul, if we look decades past in the empirical research, it actually has not performed well at all in the recent past. So certainly a difficult time for this type of investing now. And if you look at those indexes, just small cap and lower price value stock indexes, you can see why. The Russell 1000 Value Index, this is larger, lower price stocks. It actually lost more than 2%. Small cap stocks, as measured by the Russell 2000, lost more than 3% for the quarter. So those value stocks did return about 6.6% for the year-to-date period, but the small caps only bringing in about 1.7% for the year-to-date period. Should we just abandon these other parts of the market, focus on the Magnificent Seven, focus on tech? Well, we wouldn't recommend that, right? First of all, if you're in a market cap weight or you're in an actively managed type of strategy that has some cognizance of market cap weight, certainly you are already very concentrated in those large growthy stocks. You have a lot of your portfolio already focused there. Versus if you are tilting towards small cap, towards value, you have some international in the portfolio, you do have some diversification into areas where, while they're not paying off in the recent past, do, as I said, tend to pay off over the time. There's a great thesis for saying that large cap and growth will continue on its tear, right? Artificial intelligence, as long as we continue to see earnings there, more returns there, that thesis can continue forward. But of course, it's very difficult to predict these things. Hard to know how the ebb and flow of whether AI will contribute in the near term, there will be some pullback, in terms of a lot of that return already being priced in and difficult to continue those returns going forward. So having that diversification, having some exposure to the small caps, to the lower price parts of the market, to the international areas, we think is a good thing from a diversification perspective.